In the world of financial markets where uncertainty and volatility reign supreme, there are only a few tools that can serve as a true anchor for a trader. Among them, the stop loss holds a special place, and in Richard Wyckoff's methodology, it is not just a protective mechanism but a fundamental element of professional trading that distinguishes successful players from those destined for failure. It is not merely an order to limit losses. It is a philosophy that underlies capital preservation and ensures long-term survival in the market. Wyckoff, as one of the pioneers of technical analysis and an astute observer of the actions of large operators, understood that the market is an arena dominated by those who think strategically, and the retail trader must act with utmost caution and deliberation to avoid becoming a victim of these powerful players. The stop loss within Wyckoff's paradigm is your personal insurance policy for capital, allowing you to stay in the game even after a series of unsuccessful trades. It protects not only against minor setbacks, but also against those catastrophic losses that can completely wipe out a trading account, turning dreams of financial freedom into a bitter reality. Without a clearly defined stop loss, every trade transforms into a gamble, where hope replaces sober analysis, and emotions such as fear and greed dictate decisions, inevitably leading to irrational actions and financial ruin. Wyckoff taught that a professional trader always has a clear business plan, and an integral part of this plan is the strict definition of maximum risk for each trade before it is even opened. Speculation, in Wyckoff's understanding, is a disciplined approach to the market, based on objective analysis of market structure and logic, rather than blind chance or intuitive hunches. The stop loss is the physical manifestation of this discipline. It is the boundary you set for yourself to shield your trading capital from unlimited risk. It is the line in the sand that, once crossed, signals a fundamental shift in market dynamics that invalidates your initial premise. This protective measure acts as a psychological buffer, allowing you to detach emotionally from the outcome of a single trade and focus on the overarching strategy of capital preservation. The main principle of stop-loss placement, according to Wyckoff, is that it must be located at a point that completely invalidates the initial trading idea. This is not an arbitrary price, nor a fixed percentage of the investment amount. It is a strategically vital level, the breach of which by price clearly indicates that your initial hypothesis regarding the direction of price movement was incorrect. For instance, if you enter a long position expecting price growth based on the formation of an accumulation zone, and the price breaks below the lower boundary of this zone, then your hypothesis about accumulation and subsequent growth is no longer valid. At this moment, the stop-loss triggers. You close the position with minimal, predetermined losses. This is not a defeat, but a necessary part of the learning process and adaptation to changing market conditions. Refusal to embrace this idea leads to averaging down, when a trader buys more of a falling asset hoping for a rebound, or holding a position in hope, when a trader ignores losses hoping the market will reverse, which are direct paths to bankruptcy and psychological burnout. The stop loss is your exit ticket when the market unequivocally declares you were wrong. And the ability to objectively identify this point, trust it, and act accordingly is crucial for preserving your capital, your emotional well-being, and ultimately, for your long-term success in trading. This allows the trader not only to minimize losses, but also to maintain psychological equilibrium, which is extremely important in the stressful environment of financial markets. It enforces a critical self-assessment mechanism, pushing you to refine your analytical skills rather than succumb to stubbornness. Now that we understand the fundamental importance of the stop loss, let's delve into the practical aspects of its placement according to Wyckoff's methodology. This is not an art, but a science that demands a clear understanding of market structure and logic, ensuring that every placement is deliberate and well-reasoned. Defining the danger point. The key point is to understand that a stop loss is not an arbitrary price. It is not set at a distance of 1% or 2% from the entry point if those percentages do not align with market logic. Instead, it is a strategic technical point which, if reached, completely refutes your initial trading idea. This is the place where the market proves your analysis was incorrect, and further holding the position will only increase losses. Wyckoff taught to look for these danger points in the structural elements of the market, such as the lows and highs of trading ranges, key support and resistance levels, and characteristic patterns that indicate a change in the behavior of large operators. This means that a stop loss must always be tied to a specific market context, not to abstract numerical values. It is a point where the fundamental premise of your trade is violated, providing an objective reason to exit. Placement for long positions. When entering a long position, buying an asset with the expectation of price appreciation, the stop loss is placed in such a way as to protect you in case the market does not confirm the expected upward movement. Below the extreme low of a spring or shakeout after the price returns to the trading range, a spring or shakeout are Wyckoff patterns indicating the final shaking out of weak hands before an upward move begins. They're characterized by a break below the lower boundary of a trading range, followed by a swift return of the price back into the range. The stop loss should be placed slightly below the lowest point of this spring or shakeout. The logic is that if the price again falls below this level, it means the spring was false, and selling pressure remains strong, invalidating your idea of accumulation. This provides a clear, objective point of failure for your bullish thesis. Below the low of a secondary test in the accumulation phase, after the initial selling climax and automatic rally, the market often conducts a secondary test of support, checking its strength. If you enter a position after a successful secondary test that confirms support, your stop loss should be placed slightly below the low of this secondary test. If the price breaks this level, it indicates weakness in support and a potential continuation of the downtrend, signaling that accumulation may not be occurring as anticipated. Below the low of the last significant reaction, pullback in an uptrend. In an established uptrend, price moves in waves, making higher highs and higher lows. When you enter a long position during a pullback reaction within an uptrend, the stop loss should be placed slightly below the low of this last significant pullback. This low is a key support level, and its breach would indicate a potential trend change or, at the very least, a significant weakening of the upward momentum. This point represents the latest structural support that must hold for the uptrend to continue. Below key support levels identified by Wyckoff. Wyckoff's methodology pays great attention to horizontal support and resistance levels, which are formed as a result of the interaction of supply and demand. These levels often coincide with phase lines or trend lines determined by his method. When entering a long position, the stop loss should always be placed below such a significant support level. If the price breaks this level, it indicates that the demand that previously held the price is no longer strong enough, signaling a shift in market control. Placement for short positions. When entering a short position, selling an asset with the expectation of price depreciation, the stop loss is placed in such a way as to protect you in case the market does not confirm the expected downward movement. Above the extreme high of an upthrust, UT, or upthrust after distribution, UTAD. An upthrust or UTAD are Wyckoff patterns indicating the final shaking out of buyers before a downward move begins. They're characterized by a break above the upper boundary of a trading range, followed by a swift return of the price back into the range. The stop loss should be placed slightly above the highest point of this upthrust or UTAD. If the price again rises above this level, it means the upthrust was false, and buying pressure remains strong, invalidating your idea of distribution. This provides a clear, objective point of failure for your bearish thesis. Above the high of the last significant rally in a downtrend. In an established downtrend, price moves in waves, making lower lows and lower highs. When you enter a short position during a rally correction within a downtrend, the stop loss should be placed slightly above the high of this last significant rally. This high is a key resistance level, and its breach would indicate a potential trend change or, at the very least, a significant weakening of the downward momentum. This point represents the latest structural resistance that must hold for the downtrend to continue. above a resistance level that was previously support after a breakdown. When a significant support level is broken to the downside, it often turns into a resistance level. If you enter a short position after the price has broken support and return to test this level as resistance, your stop loss should be placed slightly above this new resistance level. A break above this level would indicate that sellers failed to maintain control and the market may reverse. This retest failure is a critical signal for your short entry, and a stop above it protects against a false breakdown. Above key resistance levels. Similar to support, key resistance levels identified by Wyckoff are important benchmarks. When entering a short position, the stop loss should always be placed above such a significant resistance level. If the price breaks this level, it indicates that the supply that previously held the price is no longer strong enough, and the market may continue to rise, invalidating your bearish outlook. Accounting for market noise. It is important to understand that the market never moves in a perfectly straight line. There are always random fluctuations that can stop out your stop loss, even if your analysis was correct in the long run. This is called market noise. To avoid premature exits from trades due to such minor fluctuations, the stop loss should be placed outside the expected range of normal market oscillations. This requires some breathing room for the price. One of the effective tools for determining the appropriate stop distance is the average true range ATR. ATR measures the average range of price movement over a certain period, providing an idea of the current market volatility. If you add or subtract a certain multiple of ATR, e.g. 1x, 1.5x, or 2x ATR from your danger point, it will help place the stop loss at a sufficient distance from market noise while maintaining its logical connection to the market structure. This allows the stop loss to be wide enough to avoid accidental triggering, but still narrow enough to limit risk according to your trading plan. Ignoring market noise leads to stops that are too tight, which is one of the most common mistakes beginners make. It's about finding that sweet spot where your stop respects market reality without giving up too much potential profit on a truly wrong trade. Placing the initial stop loss is just the first step. The true art of risk management, according to Wyckoff, lies in dynamically adjusting the stop loss as the trade develops. This allows not only for the protection of initial capital, but also for the safeguarding of profits already gained, transforming potential losses into controlled expenses and securing gains. Moving the stop loss to break even. Once a trade has successfully moved a sufficient distance in the desired direction, a critical stage arrives, moving the stop loss to the break-even point. This means setting the stop loss at the entry price level, or slightly above or below to cover commissions and spreads. The logic of this step is extremely simple but fundamentally important. If the market suddenly reverses and moves against you, you will exit the trade without any loss to your initial capital. You are no longer risking money from your account. You are only risking potential profit. This is a crucial stage in trade management that protects your initial capital and allows you to trade with greater confidence, knowing that the worst that can happen is to exit the trade without profit, but also without losses. Defining sufficient distance often depends on your risk-to-reward ratio. For example, if you risked $1 to earn $3, then moving the stop to break even might occur when the price has moved $1 in your favor. This allows you to remove psychological pressure and focus on further profit management, transforming a risky venture into a free trade where capital is no longer at stake. Understanding these dynamic aspects of stop-loss management is critically important, but it is only a part of the broader picture that Richard Wyckoff revealed in his works. He didn't just offer advice. He systematized principles that enable traders to see the market through the eyes of large operators, deciphering their intentions and actions. To truly delve into Wyckoff's mastery, to expand your understanding of his methods of market analysis and decision-making, we recommend exploring the adapted edition of his classic work, How I Trade and Invest in Stocks and Bonds. This book is an unparalleled source of knowledge that will allow you not only to better grasp the logic of stop-loss placement, but also to master the full spectrum of his strategies, from identifying accumulation and distribution to understanding the nuances of supply and demand. It's not just a read, it's an investment in your trading future, providing you with the comprehensive tools for deep market analysis and informed decision-making that can truly transform your approach to the markets. You can find the link to this essential book in the description below this video. Trailing stops. After you have moved the stop loss to the break-even point, the next step is to use trailing stops to protect already accumulated profits and allow the trade to develop further. A trailing stop is a dynamic stop loss that automatically or manually moves with the price as it moves in your favor, but remains stationary or lags if the price reverses. Moving the stop loss along with new higher support levels in an uptrend. In an uptrend, the price forms a series of higher highs and higher lows. When a new clear higher low, which acts as a support level, is formed, your trailing stop should be moved slightly below this new low. This allows you to lock in a larger portion of profit if the trend suddenly reverses, while still giving the trade room for further growth. This method ensures you capitalize on the trend's momentum without giving back too much when it inevitably ends. Adjusting stops according to new structural highs or lows, but only if the trend is confirmed by the market. It is crucial that the movement of the trailing stop is based on objective market structures, not on arbitrary distances. In a downtrend, the stop loss moves along with new lower highs, placing it slightly above them. Each adjustment must be confirmed by subsequent price action that confirms the continuation of the trend. You should not move the stop loss too tightly to avoid being stopped out by normal market fluctuations, but also not too far to avoid losing a significant portion of profit. The goal is to strike a balance between allowing room for natural market oscillations and protecting capital. Prohibition of moving the stop loss against the direction of the trade to increase risk. This is the golden rule of stop loss management. Never, under any circumstances, move a stop loss further away from your entry point to give the trade more breathing room when it is going against you. This is a direct violation of the principle of risk limitation and turns calculated losses into potentially unlimited liabilities. Such a decision is often driven by emotions, such as the hope that the market will definitely turn around, and is one of the quickest ways to lose capital. A stop loss can only move in the direction of reducing risk or protecting profit. This rule is non-negotiable for serious traders. Successful stop-loss management requires constant market monitoring and readiness for quick decisions. It is not a static tool, but a dynamic component of your trading strategy. Every time the market forms a new key structure, be it a new support low or a new resistance high, you must reassess the position of your stop-loss. This allows you to adapt to changing conditions, protect your capital from unforeseen reversals, and maximize potential profit by letting winning trades run as long as possible. Remember, the goal is not to never have losing trades. That is impossible. The goal is for losing trades to be small and controlled, and winning trades to be large and protected. This is the foundation of professional trading and long-term capital preservation, fostering resilience and consistent growth over time. The stop loss does not exist in a vacuum. Its effectiveness multiplies when it is integrated into a comprehensive risk management system, which is the cornerstone of Wyckoff's methodology. This means not just setting a stop, but using it as part of a broader plan that encompasses the risk-to-reward ratio and position sizing, ensuring a holistic approach to capital protection and growth. The risk-to-reward ratio rule. One of Wyckoff's most important principles, which must precede any trade entry, is the calculation of the risk-to-reward ratio. This ratio is an indicator of how much potential profit you expect to gain for every unit of risk you take. According to Wyckoff, the expected profit should be at least 3 times greater than the potential risk, a 3-to-1 ratio. This means that if you risk $100 on a trade, i.e., your stop loss implies a loss of no more than $100, then your target profit should be at least $100, $300. This calculation is mandatory before entering any trade. Why is this so important? Because even with a low percentage of winning trades, e.g., 40 to 50%, a positive risk-to-reward ratio allows you to remain profitable in the long run. If you win only 4 out of 10 trades, but each winning trade brings you 3 times more than each losing one, you will still be in profit. This is a mathematical edge that ensures the sustainability of your trading system. The stop loss is an integral part of this calculation, as it defines the magnitude of your potential risk. Without a clearly defined stop loss, it is impossible to calculate the risk-to-reward ratio, and therefore impossible to make an informed decision about entering a trade. This foresight is what separates deliberate trading from mere gambling. Position sizing calculation. After determining the stop loss and calculating the risk-to-reward ratio, the next critically important step is calculating the position size. This is perhaps the most crucial aspect of risk management, directly affecting the survival of your trading account. Position size must correspond to the distance to the stop loss and the allowable risk for your account. Wyckoff emphasized that you should never risk more than a small predetermined fraction of your trading capital on a single trade, typically 0.5% to 2% of total capital. A wide stop requires a smaller position, a tight stop allows a larger one. This is a simple but vital truth. If your danger point is located far from the entry point, i.e., you have a wide stop, then to keep the risk within the permissible percentage of your account, you must reduce your position size. Conversely, if the stop loss is located close, a tight stop, you can afford a larger position. Example: if your account is $10,000 and you are willing to risk 1%, $100 per trade. If the distance to the stop loss is 10 points, you can open a position of 10 lots. 10 points times $10 per point per lot equals $100 risk. If the stop loss is 20 points, you can only open a position of 5 lots to maintain the same $100 risk. This dynamic adjustment ensures that your capital is always protected by a consistent risk percentage, regardless of the trade's specific setup. Priority: calculate risk first, then place the stop. This order of operations is fundamental. First, you determine how much you are willing to risk per trade, e.g., 1% of the account. Then you identify a logical place for the stop loss on the chart, based on market structure. Only after that do you calculate the position size so that your risk does not exceed the set limit. Never do it the other way around. Do not set a stop loss to fit a desired position size, and do not open a position and then look for where to place the stop. This is a path to uncontrolled losses and ultimately account depletion. Capital discipline. Wyckoff stressed that successful trading is not about big wins on a single trade, but about consistent capital preservation and its gradual growth. Risking only a small fraction of your account is not just a recommendation. It is an iron rule for survival in the market. Even the most experienced traders face series of losing trades. If you risk too much on one trade, one or more such series can quickly wipe out your account. Adhering to capital discipline expressed through conservative position sizing and a clear stop loss allows you to weather these periods and stay in the game, waiting for the next high-probability opportunities. This psychologically frees you from excessive pressure, allowing you to make more rational decisions, knowing that no single trade can fatally wound your capital. It builds resilience and a long-term perspective essential for enduring the inherent volatility of the markets. Even with a thorough understanding of Wyckoff's principles, traders often make common mistakes that can negate all their efforts. Avoiding these pitfalls is just as crucial as correctly applying the principles themselves, as errors in execution can be as damaging as errors in analysis. Absence of a stop loss. This is, without a doubt, the most catastrophic mistake a trader can make. Trading without a stop loss is not trading. It is a blind gamble based on hope, not on a clear business plan. A trader who does not set a stop loss essentially accepts unlimited risk. They hope the market will definitely turn around, ignoring all signals that their initial idea was incorrect. The consequence of this is a potentially complete loss of capital. Remember, the market can move against you much longer than you can remain solvent. A stop loss is your insurance, your exit ticket from a trade that is not going as planned. Never trade without it, as it is the ultimate safeguard against financial ruin. Arbitrary stop loss. Another common mistake is using fixed percentages or dollar amounts to set a stop loss without considering the current market structure. For example, setting a stop at 2% from the entry price, regardless of where key support or resistance levels are located. Such an approach ignores the logic of the market. A stop loss must be placed where the market objectively proves you wrong, not where it is convenient for you or where it meets an arbitrary percentage. If 2% of the entry price falls in the middle of a trading range, such a stop loss will be easily triggered by random fluctuations, leading to a series of small but frequent losses. Always tie your stop loss to meaningful market structures that provide a logical point of invalidation. Moving the stop loss to increase risk. This is the sin of ego in trading. When a trade goes against you and the price approaches your stop loss, there is a temptation to move it further away to give the trade more breathing room, hoping the market will reverse. This destroys discipline and turns calculated expenses into unlimited liabilities. If you have already determined that a certain point invalidates your trading idea, then moving the stop further from that point is irrational. It means you are allowing emotions to override the logic of your trading plan. Stick to your initial plan. If the stop loss is triggered, accept the loss and look for a new opportunity. This adherence to predefined rules is paramount for long-term survival. Placing the stop loss too closely. This is the sin of fear. Beginners often place stop losses too close to the entry point, fearing large losses. However, this leads to premature exits from trades due to normal market fluctuations, known as market noise. The market rarely moves in a straight line. It needs room to breathe. If your stop loss is too tight, it will be constantly triggered, even if your analysis was correct, and the price eventually moves in your favor. This leads to frustration and loss of confidence, causing traders to abandon sound strategies. Always account for market volatility and use tools like ATR to give your stop enough room, balancing risk limitation with allowing the trade to develop naturally. Not adjusting stops. Once a trade is successfully developing, not adjusting stop losses is a missed opportunity to lock in profits or, in the worst case, incur larger than expected losses. Leaving a stop loss at the initial level when the price has moved a significant distance in your favor means ignoring the trade's progress. If the market suddenly reverses, you could lose all accumulated profit or even incur losses that could have been protected by moving the stop to break even or using a trailing stop. Dynamic stop-loss management is key to protecting your capital and profits, ensuring that your trading strategy evolves with the market's movements. Ignoring volatility. Markets are constantly changing. The same asset can be highly volatile in one period and calm in another. Ignoring the current market volatility when setting a stop-loss is a serious mistake. Stops set too tightly in a volatile market will be constantly triggered. Stops set too widely in a calm market will lead to excessive risk per trade. Always adapt the size of your stop loss to the current volatility, using indicators like ATR. This will allow you to place stops that match market realities and your trading plan, ensuring your protection is appropriate for the prevailing conditions. Emotional trading. The most insidious mistake is allowing hope, fear, or greed to dictate stop-loss decisions instead of market logic. Hope makes you avoid setting a stop-loss or move it further away. Fear makes you set it too tightly. Greed can make you refrain from moving a stop-loss to lock in profits, hoping for an even bigger move. Wyckoff taught that successful trading requires objectivity and emotional control. Your trading plan, including stop-loss rules, must be clear and strictly adhered to regardless of your emotions. This is the only path to consistent results. Understanding such psychological traps and avoiding them is an integral part of successful trading. It's part of the knowledge we constantly share. If you aim to deepen your understanding of trading strategies, methods, and principles of specific traders, speculators, and investors, and also wish to learn about historical events, financial crises, and prominent figures of Wall Street, then you should pay attention to our channels. We invite you to subscribe to Trading Insights, where we dissect effective strategies and provide actionable guidance, and to Wall Street. Memoirs, where you'll find fascinating stories that shape the financial world, offering invaluable context and lessons from history. These channels will become an invaluable resource on your educational journey, providing you not only with practical tools but also a deep understanding of the context in which these tools are applied, enriching your perspective and decision-making process. Links to both channels can be found in the description below. Remember that the market has no emotions, and you, as a trader, should not allow them to govern your decisions. Every time you place a stop loss, ask yourself, is this decision based on an objective analysis of market structure and my trading plan, or on my personal emotions? An honest answer to this question will help you avoid many common mistakes. Disciplined use of stop losses is not only a risk management tool, but also a powerful means for developing your trading psychology. It trains you to accept losses as an inherent part of the business, allows you to quickly move on and seek new, more promising opportunities without getting stuck in past failures. This is precisely what distinguishes a professional trader from an amateur, a crucial distinction for long-term success. Richard Wyckoff's methodology is renowned for its universality. The stop-loss principles we have discussed are not limited to one asset type or one time frame. They are fundamental and can be adapted to a wide range of market conditions, making them incredibly versatile for any trader. Universality of the method. Wyckoff's principles, including the logic of stop-loss placement, are applicable to virtually any financial instrument where the interaction of supply and demand is present. This means you can successfully use them for trading stocks, forex, currency pairs, cryptocurrencies, commodities, e.g. oil or gold, and other assets. The essence of the method lies in analyzing market structure, volume, and price action, which are universal across all markets. Regardless of whether you are trading shares of large companies or speculating on Bitcoin fluctuations, Wyckoff's fundamental logic for identifying the danger point remains unchanged. It is only important to adapt specific tools, e.g. ATR size, to the specifics of volatility and liquidity of each particular market. This makes Wyckoff's methodology an extremely powerful tool for any trader seeking a robust and adaptable framework. Adaptation to time frames. Wyckoff's method, including its approach to stop losses, works on all time frames, from minute charts for day trading to monthly charts for long-term investing. However, there are certain nuances that must be considered. Higher time frames yield stronger signals. The general rule is that signals obtained on higher time frames, daily, weekly, monthly charts, are more reliable and less prone to noise compared to lower time frames, hourly, 30-minute, 5-minute. This is because on higher time frames we observe the actions of larger operators and long-term trends, which are harder to reverse. Therefore, stop losses placed based on the analysis of higher time frames will generally be more justified and less prone to premature triggering, offering greater stability and confidence in your trade setups. Day trading may present challenges due to stop hunting by large players. On lower time frames, especially 1-minute or 5-minute charts, the market often becomes more noisy and susceptible to manipulation. Large operators may actively hunt for stops of retail traders, deliberately moving the price to levels where they know numerous stop losses are placed, to trigger these orders and use them to accumulate or unload their positions. Because of this, Wyckoff is often better suited for swing trading and position trading, where trades are held for several days or weeks. On these time frames, the impact of market noise and stop hunting is less pronounced, and Wyckoff's structural levels are more reliable. If you do use Wyckoff for day trading, be especially cautious. Use wider stops relative to the time frame's volatility, and always confirm signals with volume. Context of market phases. Stop-loss placement must consider the current market cycle phase in which the asset is located. Wyckoff's methodology identifies four main phases. 1. Accumulation. This is the phase when large operators gradually accumulate positions, preparing for an upward movement. In this phase, stop losses for long positions are placed below the lows of a spring or secondary test, as we discussed. If the price breaks these levels, it means that accumulation did not occur or has turned into distribution, invalidating the bullish premise. 2. Markup. The phase of an uptrend when the price is rising. Stop losses for long positions are moved along with new higher lows, protecting profits as the trend progresses. The trade is closed if the price breaks a significant support level or forms distribution patterns, signaling a potential reversal. 3. Distribution. The phase when large operators gradually unload their positions, preparing for a downward movement. In this phase, stop losses for short positions are placed above the highs of an upthrust, or UTAD. If the price breaks these levels, it means that distribution did not occur or has turned into accumulation, invalidating the bearish premise. 4. Markdown. The phase of a downtrend when the price is falling. Stop losses for short positions are moved along with new lower highs, protecting profits as the trend continues. The trade is closed if the price breaks a significant resistance level or forms accumulation patterns, signaling a potential reversal. Using volume to confirm trend strength and signal reliability. Volume is an integral part of Wyckoff's analysis. It helps confirm the strength of price movement and the reliability of structural patterns. For example, a spring or upthrust with high volume followed by a decrease in volume as the price returns to the range is a stronger signal. If a stop loss is placed based on a pattern confirmed by volume, its reliability increases. Conversely, if volume does not confirm price movement, then a stop loss placed based on such movement is less reliable. Always integrate volume into your analysis when determining the danger point for your stop loss, as it provides crucial insight into the underlying buying and selling pressure. We have come a long way examining the fundamental importance of the stop loss, the principles of its placement according to Wyckoff, dynamic management, and integration with risk management. We also discussed common mistakes and the adaptation of the method to various market conditions. Now it's time to summarize why the stop loss is much more than just an order to close a position. It is a true financial compass guiding the way to stability in turbulent markets. The stop loss is not only a technical tool, but also a means for developing trading discipline and overcoming emotions. At its core, the stop loss is an expression of your willingness to admit you are wrong and accept a small loss, rather than allowing emotions of hope or fear to dictate your decisions. When you set a stop loss, you preemptively accept the fact that your trading idea might be incorrect. This frees you from the psychological burden of constant monitoring and hoping for a miracle. You know that the worst-case scenario is limited, and this allows you to trade with greater confidence and calm, focusing on market logic rather than internal anxieties. Disciplined adherence to stop-loss rules cultivates rationality, objectivity, and self-control in a trader, qualities that are indispensable for long-term success in any field, especially in trading. This allows you to avoid so-called big losses, which are the main cause of bankruptcy for the vast majority of novice traders. Learn to accept small losses as an integral part of the business, and you will preserve your capital for big wins that will surely come with experience and consistency. Adhering to stop-loss rules allows a trader to stay in the game and maximize profit potential. When you effectively limit your losses, you preserve your capital, and preserved capital is the most valuable resource, giving you the opportunity to open new, more promising trades when high-probability opportunities arise. It's like having a second life in a game where each round is a new chance. Every time a stop-loss is triggered, it's not the end of your trading journey, but simply a signal to reassess the current situation and look for a better entry point based on updated analysis. This gives you psychological resilience and financial flexibility to continue trading even after a series of setbacks without letting them derail you. Moreover, proper stop-loss management, especially using trailing stops, allows you to ride profitable trades for as long as possible while locking in a significant portion of the profit, which is critically important for realizing a positive risk-to-reward ratio, that very mathematical edge that is key to long-term profitability. This enables you not only to survive but also to thrive in the market. Mastery in placing and managing stop losses is crucial for long-term success in trading according to Wyckoff's methodology. It's not just a set of rigid rules. It's an art that develops with experience, continuous market observation, and relentless learning. It requires a trader to have a deep understanding of market mechanics, the ability to interpret price action and volume from the perspective of large operators, and iron discipline to strictly execute their trading plan. Remember that Wyckoff did not just develop a technique of analysis. He developed a holistic philosophy that helps traders think like large operators, understanding their intentions and actions. The stop loss is an integral part of this philosophy, providing capital protection and psychological stability, allowing the trader to act rationally under any conditions. Your ability to effectively use a stop loss will determine your ability to stay in the market and achieve long-term success. It is the foundation upon which your entire trading career is built. Without this solid foundation, even the most brilliant trading strategies are doomed to fail, as capital will be lost long before they can bear fruit. Therefore, pay due attention to this aspect of trading, constantly improve your skills, and make the stop loss your most loyal and reliable ally on the path to financial success. Learning to correctly use Wyckoff stop losses is one of the most important steps on the path to professional trading. It requires practice, patience, and iron discipline. Every element, from the initial placement based on the logic of market structure to dynamic adjustments that protect profits and integration with risk management, is vital for your survival and prosperity. We hope this guide has provided you with a clear and comprehensive understanding of how to apply these principles in your own trading, giving you a roadmap for effective risk management. Remember that every successful trader, from legendary figures of the past to modern market masters, started with the basics, and risk management was always at the heart of their focus as an integral part of their business plan. It is not an option, but an obligation that you must accept if you aspire to serious results. Start applying this knowledge today to protect your capital and build a strong foundation for your trading future, transforming potential catastrophes into controlled and predictable expenses. Speaking of legendary figures and fundamental principles, one cannot fail to mention another giant of the financial world whose experience and trading psychology remain relevant to this day. For those who seek to deepen their understanding of market psychology and strategies that have stood the test of time, we highly recommend the new edition of Reminiscences of a Stock Operator. This book offers a profound analysis of Jesse Livermore's psychology and strategies, supplemented with commentary and analysis for each chapter, transforming his experiences into practical lessons for the modern trader. It's not just a retelling of history, but a comprehensive guide that helps understand how emotions influence trading decisions and how to control them, which is key to avoiding many of the mistakes we discussed earlier. A link to this valuable edition can also be found in the description. Studying such classic works, supplemented with modern analysis, is an indispensable part of becoming a true market master who understands not only what to do, but also why to do it. Stay disciplined, keep learning, and never underestimate the power of a properly set stop loss. It is your most faithful protector on the path to success, your silent partner who always stands guard over your capital, ensuring your longevity in the challenging world of financial markets.